In an era where retail landscapes are rapidly evolving, convenience stores, once the backbone of quick shopping and late-night necessities, are facing unprecedented challenges. Today, we're going to explore 15 convenience store chains that might disappear from our streets forever, and the fascinating reasons behind their potential downfall. Let's start with Family Express, a Midwest favorite that's been struggling to keep up with modern consumer demands. Founded in 1975, this chain has been fighting an uphill battle against bigger competitors and changing shopping habits. The company's reliance on traditional convenience store models without significant investment in digital integration or mobile ordering has left them vulnerable in today's tech-savvy market. Their recent financial reports show a 15% decline in same-store sales, and industry analysts predict they might not survive beyond 2026. Next up is Cumberland Farms, which, despite its rich history dating back to 1939, is showing signs of serious trouble. The chain, known for its dairy products and coffee, has been closing locations across the Northeast. The problem? They're caught in a difficult position between discount chains like Dollar General and premium convenience stores like Wawa. Their operating costs have increased by 23% since 2022, while revenue has remained relatively flat. The company has already shuttered 50 locations in the past year alone. Circle K, owned by Alimentation Couche-Tard, might surprise many by making this list. While they're currently a major player, their traditional business model is under severe pressure. The shift toward electric vehicles is particularly threatening, as fuel sales account for nearly 70% of their revenue. Their attempts to install EV charging stations have been slow and costly, and their locations are often in areas where EV adoption is low. Market analysts suggest that up to 30% of their locations could close by 2027. QuikTrip, despite its loyal customer base, is facing similar challenges. The company's heavy concentration in suburban areas is becoming a liability as urban centers become more populated and suburban shopping habits change. Their food service model, once innovative, now struggles to compete with specialized quick-service restaurants and delivery apps. Recent financial disclosures show their profit margins have dropped from 8% to 3% in just 2 years. Stewart Shops, a beloved Northeast chain, is another potential casualty. Their dairy-focused business model, while unique, is becoming increasingly difficult to maintain as milk consumption continues to decline. The company's reluctance to embrace mobile payment systems and delivery services has left them behind competitors. They've already announced the closure of 15 underperforming locations, with more likely to follow. Speedway, even after its acquisition by 7-Eleven, isn't immune to these industry-wide challenges. The merger has led to operational inefficiencies and brand identity issues. Many locations are struggling to maintain profitability, particularly in rural areas where population decline is affecting foot traffic. Industry experts predict that up to 1,000 Speedway locations could be closed or rebranded in the next few years. Casey's General Stores, despite its strong presence in the Midwest, is showing concerning signs. Their pizza-centric food service model, while popular, has become increasingly expensive to maintain due to rising ingredient costs and labor shortages. The company's rural focus is becoming problematic as these areas continue to lose population. Their stock price has dropped 25% in the past year, reflecting investor concerns about their long-term viability. Kum Go, another regional player, is struggling with modernization costs and changing consumer preferences. Their attempts to upgrade stores with fresh food options and modern amenities have strained their financial resources. The company has already sold several locations to competitors and is actively seeking buyers for underperforming stores. Their traditional business model, heavily dependent on fuel sales and impulse purchases, is becoming increasingly unsustainable. Holiday Station Stores, despite its strong regional presence, is facing significant challenges. The company's aging infrastructure and limited digital capabilities are making it difficult to compete with more modern convenience stores. Their recent attempts to modernize have been hampered by high costs and technical difficulties. Market analysts suggest that without significant investment or a strategic buyer, the chain could face substantial downsizing or closure. GetGo, owned by Giant Eagle, is another chain that might not survive the current retail transformation. Their hybrid convenience store or gas station model is becoming less relevant as consumer habits change. The company's attempts to integrate with Giant Eagle's supermarket business haven't produced the expected synergies, and their locations are often in areas with declining foot traffic. Financial reports indicate that 40% of their locations are operating at a loss. United Dairy Farmers, despite its long history and loyal customer base, is struggling to adapt to modern retail requirements. Their focus on ice cream and dairy products, while distinctive, isn't enough to sustain their business model in today's market. The company's limited digital presence and aging store designs are making it difficult to attract younger customers. They've already closed several locations and are actively reviewing their entire store network. Sheetz, while currently successful, is showing early warning signs that could lead to future troubles. Their heavy investment in made-to-order food and modern store designs has led to high operational costs, and their expansion plans have strained their financial resources. The company's debt load has increased significantly, and their profit margins are shrinking. While immediate closure isn't likely, significant restructuring might be necessary. Royal Farms, known for its fried chicken and convenience items, is facing increasing competition and operational challenges. Their food service model, while popular, requires significant labor and equipment investment, and rising costs are eating into their profits. The company's concentration in mid-Atlantic states makes them vulnerable to regional economic downturns. Several locations have already been put up for sale. Thorntons, despite recent ownership changes, continues to struggle with market positioning and operational efficiency. Their attempts to upgrade stores and expand food service options haven't produced the expected results, and their heavy reliance on fuel sales makes them vulnerable to changing transportation trends. Industry analysts suggest that up to 40% of their locations could be closed or sold in the coming years. Finally, Pilot Flying J, while primarily known for serving truckers, is facing existential challenges as the transportation industry evolves. The shift toward electric vehicles and autonomous trucks threatens their core business model. Their attempts to diversify into other services haven't offset the declining fuel sales, and their large format stores are becoming increasingly expensive to operate. While they're unlikely to disappear entirely, a significant downsizing seems inevitable. These potential closures reflect broader changes in consumer behavior, technology, and economic conditions. The convenience store industry is at a crossroads, and only those who can successfully adapt to changing consumer needs while maintaining operational efficiency will survive. The next few years will be crucial in determining which chains can successfully navigate these challenges and which will join the growing list of retail casualties.